My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to save you a little money. My job is not just to entertain, but to educate and explain this crazy stuff. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Stop rubbernecking! That's my suggestion to anyone who's hoping to find a bottom in the train wreck that is tech. You want to start buying when the accident's over. But what if the accident's still ongoing? Why get involved in the pileup? I'd much rather use ways to avoid the accident entirely. I think this is an essential point on a sedate day like today, of course not underneath, where the Dow inched up 3 points, S&P declined 0.16%, but here we go again, the NASDAQ lost 0.59%. Right now, there's a consensus that tech's done going. Yeah, you know that, I know that. I mean, there's got to be some value. There's got to be some value somewhere, doesn't there? After all, I mean, how can stocks be down 50, 60, 70, 80% and not have some value? That was my reaction when I read a research report downgrading Roku this very morning, the digital TV play, which had already plummeted from nearly 500 to the low 50s. And I saw, after the downgrade, that the stock failed to go down. So there was something akin to rubbernecking here. An analyst who recommended Roku at 228 in September 2020 rode that buy all the way to the stock's high of 490 and change, then rode it back down and jumped off here in the 50s?
The House of Pain.
With the stock failing to go down when he finally took it off the buy list? I thought to myself, aha, doesn't that have to be the bottom, right? I mean, the clearing of the accident, downgraded, no doubt there. Can't we finally consider Roku de-risk? Can't we finally start? Buy. Roku! But then you actually read the report, and there's simply no reason whatsoever to buy this thing. I mean, Roku is losing a ton of money, and the losses are only going to get worse. The revenues are slowing. They're losing market share to connected TV. They've got no real mode. Their advertising business is on the decline. There's simply no reason to think that Roku's bottomed other than dramatic irony. Some guy who liked it all the way down abandoned ship, and the stock didn't react. Well, there is a real reason. I'm not picking on Roku, or even the analysts. Sure, it might look silly to downgrade a stock that's already off 76% for the year, but there's a reason they threw in the towel. This is a company with lots of problems and no solutions. There's no reason to own it unless you're expecting a takeover bid, but nobody would want to acquire this thing unless they could get it for much lower, and that's assuming the deal doesn't get blocked by the Federal Trade Commission. They know nothing! Which has become ferociously anti-merger. But Roku's just an example of what I'm wary of as we head into a period where lots of tech companies are reporting. I'm worried that they're simply piling up again, and watching this pile up is just plain sad. I'm sure some of the proverbial cars aren't damaged, but maybe they can even extricate themselves from the pileup. But many are indeed like Roku. They've got almost nothing going for them, except that their stocks are down so much that people figure, well, they can't possibly go any lower. But that's not true. It can always go lower until it gets to zero. Stocks do stop at zero. I've been around. I know this. Witness CrowdStrike this very evening, a fine company that guided lower tonight, the first real miss in this fine cybersecurity company's public history. Fine. What caused it? Macroeconomic headwinds. Ouch! I've been through something like this before. During the dot-com collapse over 20 years ago. From 1999 through 2000, some 330 companies came public. Only a handful of them ultimately made it out. Well, that's only a handful made it to the promised land. Yet at every step of that decline, you know, there were people who simply had to take a stab at it. And that's how we felt it was, a stab. There's something alluring about, alluring, A-L-L-U-R-I-N-G, really hard word for Philadelphians to say. Something alluring about trying to find, buying something knowing that you're buying far away from the top. So why not get in much lower than those who were foolish enough to buy the same stock near the peak? I mean, aren't you so much smarter than they are? It's alluring, but you know what? There's no real logic to buying a dog. all you're doing is guessing whether a stock's done going down. You aren't analyzing the underlying company. Separate stock from company. You know we teach that all the time here. So when you looked at the tech stocks back then and bought because they were down 50, 60, 70, 80%, what you missed was that you were buying a piece of paper that was still at a huge disconnect from the underlying company. Who cares if it's down 80% from the high when there's a high chance that the business is going under? Of course, I like the dot-com era. Many of these biggest losers are actually making money. Let me just, I don't want to confuse this. There's a much better crop than we had in that period. I brought the Street.com public in 1999. I know what bad is. These are much better stocks. But why don't we just pick an example? Look, we just had them on Zoom video, okay? No danger of them going out of business. But the stock is down from 588 at the height of the pandemic to just under $70 now. That's still a loss. Zoom's a lot less essential in a post-COVID world, but it's still very profitable. You know, it could make nearly $4 per share this year. It's sitting on $5 billion in cash. That's huge. The stock's only worth $20 billion. But I could have said the same thing when it was valued at $25 billion or $30 billion or $40 billion. Well, it's better than its analogs in 2000. That kind of analysis would have lost you a fortune last year. And I'll bet it's going to keep you losing money because the analysts think Zoom can only earn $3.53 per share next year. That's right. You're looking at a down year, and no portfolio manager worth their salt wants to buy stock in a company that's going to have a down year. Now, maybe Zoom, you think, I got an idea. Maybe Zoom can reignite itself, right? Smart people can win. I mean, come on. I think they can use that $5 billion and change to change their stripes. Certainly possible. A few weeks ago, we interviewed Kelly Steckelberg, Zoom's terrific CFO. She talked about all sorts of cool initiatives. I thought they were cool, including a way to look up parts of conversations by keywords. But if you bought it based on an interview, you're now down 10%. Do you know how many times people have tried to find the bottom in Zoom? Betting that it can't be like 2000 because it's very profitable and it's a very good business, and it hasn't mattered at all. And Zoom is among the best of these enterprises. There are so many. There's so much money. People are buying companies based still on a price-to-sales basis. Even though I've told you over and over again, please, price to earnings. Don't buy stocks that are losing money. Even if the sales are being hurt by a slowing economy. Again, to some extent, these tech stocks have been somewhat de-risked. I'll give you that, because they're down a great deal, and the underlying companies have admitted that business has slowed. But I say that they won't truly be de-risked until management decides to pivot from a growth at all cost mindset, the vast majority of these companies are still doing that, to a profitability at some cost mindset, like we saw recently from Palo Alto Networks, whose stock is being brought down tonight by CrowdStrike. Unfortunately, these stocks are few and far between, and the good ones are indeed being taken down by kind of a reverse Gresham's law. No, it's a Gresham's law for stock market. Like the bad stocks are driving out the good. Now, I'm not against owning some tech at all. We own some profitable ones with real moats and pricing power for the Travel Trust. You can follow along by joining the CNBC Investing Club. I wish you would. We teach every day. Yet even those higher quality techs are down a great deal, and they got hit yet again today. If you want to own tech here, you have to know what you're getting into, because in this environment, it takes a lot of patience. And there will be pain.
The house of pain.
And ultimately, some will produce gains, but not quite yet. However, you don't have to own tech. That's the point of what I'm talking about. I say put on Waze. I know how to use Waze. I learned. And go down other streets, the industrial street, the food street, the drug street, the oil street even. When you go down Tech Avenue, the police wave you by and say, hey, look, there's nothing to see here. Keep going, keep going. But on these other streets, there's something to see and something worth buying. Bottom line, why rubberneck when you can invest in stocks of companies that have a lot going for them? I think that's much better than sifting through the wreckage of tech simply because their stocks are down a great deal and you figure enough is enough. Sadly, for the bulls, history says that's just not true. Ann in Indiana. Ann.
Hey, Jim, thanks a lot for taking my call.
Of course. What's up, Ann?
I'm a super happy club member, so grateful. And I'm long Lilly stock, but I also have some calls on Lilly. I'm up about 80%. They expire mid-January. So could you coach me up a little bit about how and when to trim and close the position?
Okay, sure. First of all, I don't advise on options, and I would take the profits in those, even though, we have a huge position in Eli Lilly for the club. I do worry. And look, everyone's saying that Lilly's Alzheimer's drug is not as good as some of the others. It's in early stages. I'm not willing to say that. I do know that their anti-obesity drug is going to be the star of late 2023. Sell the calls, keep the common. It's like, keep the cannoli, whatever. Stop rubbernecking. That's my suggestion to anyone who's hoping to find a bottom in the train wreck that is tech. Oh, man, tonight, Emerson Electric held an investor conference earlier today. I'm taking a closer look at the headlines, company's top brass. Then, can the rally off the lows keep going? I'm going off the charts to get a technical look at where this market could be headed. And it's iffy. Oh, and Dycom's recent downfall after earnings, could it be a buying opportunity? I'm turning in my homework on the stock after you asked about it in last night's lightning round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.